Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. And give us a wide shot of the studio here, Brent, just so everybody knows what's going on. So if you can't tell, today's my birthday. Thank you to Michelle Ratliff, who has done all the decorating this morning. So thank you very much. I appreciate it. 60 years old today. I got an email this morning from a longtime reader. And there are longtime readers of our newsletter, and then there are longtime readers of our newsletter. And he emailed me a copy of my newsletter from 2008 when I turned 43. And I mentioned my birthday. So thank you very much for going in the way back machine, just reminding me just how old I am today. So. Anyway, hope you all had a wonderful Mother's Day yesterday with your family, and so now today we get back to work, and lots of news over the weekend. So it's always interesting. So it takes me a few days to write an article, and so I wrote an article this morning talking about the bear market rally, and this has been a lot of headline news as of late. It's a bear market rally. It's just a rally. It's going to fail. And the one thing that's really been driving this market as of late is just a function of concerns over these tariffs. And so I wrote this article and I went through kind of the cases for and against a bear market rally. And pretty much that article is useless this morning because yesterday the Trump administration announced a resolution on the one thing that has been really weighing on the markets, which has been China and the Chinese tariffs, 125%. So that tariff has been rolled back to 30%. So it's 10% plus 20% as where all this, we just went back to where we started, but only for 90 days. So we've repealed the tariff for 90 days back to 30%. But markets like that this morning, and this morning markets are going to open up sharply higher. Dow's going to be up about 1,000 points here at the open. S&P is going to be up over 2% this morning, and we'll get into the technicals of it in a minute. But a lot of this kind of negative sentiment is continuing to drive this market higher because a lot of people have been really caught off sides here and now are having to come back into the markets as well. Now, one sector that won't do well this morning is healthcare. That's because the Trump administration is vowing to get drug prices cut by up to 59% to 80%. So again, this has been one of kind of the caveats of RFK Jr. as well as the Trump administration is getting drug prices down. And this is going to kind of be the next area of attack. So companies like Eli Lilly, AbbVie, United Healthcare, they're all under pressure this morning. So when you take a look at the heat map of the markets, it is bright green in 10 out of 11 sectors. Healthcare, not so much this morning. And if it wasn't for healthcare really dragging this market would be up a good bit more, probably closer to 4% at the open, because healthcare is a fairly sizable weighting in the index itself. So, that's the one kind of anchor that's really kind of suppressing this rally. Otherwise, this rally would be even bigger coming out of the gate this morning. But again, this is something that we've talked about that would happen. And we've got a lot of negative sentiment, a lot of negative positioning in the markets. A lot of people still, just kind of waiting for that next shoe to drop. And it may, right? Once we get past all of these, tariff announcements, we still have to deal with the economics of everything. But at least for right now, the real kind of big news is off. The one kind of the big drag to the overall market is now off the table, at least temporarily. So that's giving traders a bit of reprieve this morning, and certainly making retail investors look pretty smart because retail investors had been piling into this markets here really ever since the low. And they've been well rewarded for buying the dip. So this has been the big challenge for for investors in general is the fear about the Trump administration and what's happening with tariffs and all this stuff, and all that stuff is just continuing to fade away. And this is an important point that we talk about a lot. most of the time, the vast majority of the time in the markets, the things you fear the worst never happen. And so letting big overriding news stories weigh on you is never worked out well for investing over time. In fact, I'm having a Twitter debate this morning with a gentleman talking about valuations are still high. Yeah, valuations have been high for 25 years. Do you want to still sit out of the market just because of high valuations? Or do you want to make some money? And that's really where we got to get back to. And that brings us to what you need to know before the bell this morning. So again, kind of the big driver this morning right out of the gate is going to be this news about the administration. And one thing that is continuing here, and we've kind of watched this for a while, if I can get this to go away, is this kind of this technical support line that we've had going back to these lows that we had when we first started this whole kind of tariff negotiation, starting to talk about tariffs, etc. Then, of course, we had Liberation Day that broke all that. Now we've taken that support level back and out, right? We've taken that resistance level out. We're back into support. This morning, we are going to be moving above this conglomeration of resistance at the 100 and 200-day moving average. This is that last line of defense between where we are right now and new highs. So if the markets can get through this and hold, right? They've got to hold above it. Just because we get above it for a day and then fell tomorrow, that's not a successful breakout. But if markets can move above this resistance level and take out that resistance, then that clears the way for this market to move back towards all-time highs. Now, I know that seems kind of hard to fathom given all the stuff that's going on in the markets, but markets are markets, and markets are going to do what they want to do. Markets are overbought here on a couple of different fronts. Momentum is certainly getting quite elevated here. Relative strength is elevated. And again, relative strength has been fading here over the last couple of days. So again, we're starting to see a little bit of a negative divergence between relative strength and the markets. We'll see what happens today. But again, this has been kind of this fight that we've been talking about with investors here for the last couple of weeks in particular, because this is where it becomes challenging as an investor, is to kind of put those emotions aside and just read what the market's telling you. And this market has been very bullish. Money flows have been coming back in. Relative strength has been improving. Momentum has been improving, and a lot of investors are just just fighting that whole rally higher rather than just letting it participate. And again, we're just, to be clear, we're holding, a higher level of cash than normal. We do have a short position in our portfolio that will likely get removed here once we get confirmation that, this market is finished with this correction process. And that's really the gist of today's article on the website was this just a correction? Is the correction now over? Or is there another leg lower here coming for some reason? And again, there's, people always say, Lance, can't you just tell me what's going to happen? I'm not prescient. I wish I could tell you with certainty what's going to happen, but all we can do is analyze probabilities and possibilities. And technically, we're starting to get into areas that suggest this was indeed just a correction, and that is now over. Doesn't mean we're not going to have another correction, down the road somewhere, but again, expectations of a return to a bear market, a recession, all those type of things are slowly fading away here. So be careful fighting that narrative as we go. One of the big beneficiaries of today's announcement is going to be the dollar. Strong move up in the dollar. That's starting to pull risk assets. That's also pulling money back into markets. As the dollar strengthens, that drags in foreign inflows and money back into U.S. equities. That's helping support this rally. One of the non-beneficiaries today of this, of course, is going to be gold prices. As we've talked about before, gold is a liquidity source during a risk-on rally. So again, as you see that today, gold is declining about 3% this morning, as simply as just taking profits out of one area and putting it into another area. So again, this isn't a narrative on the world debts, deficits, currencies. That's not the way markets work. You can apply rationale to these things. But in reality is that you had an asset that was going up. It was extremely overbought. That money's now coming out, going back into other assets that present a better short-term trading opportunity. That's all that's happening. It's just a rotation in the market, nothing more, nothing less. But that's what you need to know this morning before the bell. When we come back, we'll get into, is the correction over? Is it a bear market rally? Lots of other stuff we're going to get into this morning as well. Thank you for joining this morning, my birthday, right here on The Real Investment Show. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I need to elicit the help in our chat this morning a little bit. A while back, I was talking about on the show that I was looking for an older truck, like an International Scout, something like that from the 1970s, that kind of a project car, those type of things that I wanted to work on. And one of our chat members, listeners, started emailing me some links for this stuff and emailed me on Tuesday or Wednesday, 1971 International Scout that's up for auction. And so what I need your help with this morning is what should my max bid be for this auction? So it started at $12,000. It's currently at $35,000. So I'm starting to kind of just things get a little bit out of my price range for what I want to pay for one. But so what do y'all think? So if y'all want to do some quick research, 1971 International Scout, great condition, fully running, fully operational, needs no work whatsoever. It's been completely refinished front to back. So it's just basically a buy and drive. Mileage is, it's got a brand new engine in it. So mileage is like 700 miles right now. Yeah. So anyway, so if you want to help, feel free to jump in chat and we'll see. Lonnie Evans says bid $1. That's where I started. So anyway, so a couple of things to talk about. So it was interesting this morning. I got into a Twitter debate with a guy this morning, and this goes to kind of what's going on in the markets in general. And, we've talked about this a lot and, in the past, and, what's important is to understand how things operate. And, valuations are a good measure of understanding what people are willing to pay for something, right? And the problem with valuations is that valuations are expensive, yes, but they're expensive relative to what? And does it change the dynamic of what people are willing to pay? Because at the end of the day, all valuations measure is sentiment, right? What people are willing to pay for something. And so, yes, valuations are expensive, but that doesn't mean everything is expensive. As we've talked about on the show, previously, if you take a look at NVIDIA, it trades at a PEG ratio of 1.2. You just immediately assume the Mag 7, right? It's just those are really expensive. Some of them are, right? But Google's trading at basically a 17 PE. Market's trading at 25 on a forward or 22 on a forward. So, that doesn't mean that just everything is expensive just because valuations on a market are expensive. And then also we have to put it into context is that valuations, yes, they're more expensive than they were back in the 1960s because you have a lot more participation in markets today. Companies are more efficient today than they were back in the 60s. And so valuations have been, the average or the median valuation has risen over the last 25 years. So 22 times forward earnings is, yes, more expensive than it was back in the 60s or 70s, but the average forward valuation since 2000 has been around 17, 18. So it's still expensive, right? But not exorbitantly expensive. And so one of the comments, it comes back, but he says Warren Buffett, so I guess you assume that Warren Buffett's an idiot. No, Warren Buffett's not an idiot. Yes, his market cap to GDP ratio is certainly quite elevated, but, and yes, he's holding a lot of cash right now, but he's not out of stocks, right? He still owns Apple. He still owns, companies in his portfolio. He has sold some, he has raised some cash, just as any good manager would do, but he's still long equities. So the point is making these decisions to be all in or all out, right? Do you want to make money in the markets or not? Sometimes we have to understand the market that we're in and say, okay, look, I'm not a long-term investor. I'm not going to buy something today and go, I'm just going to hold this for 50 years, right? It just we can't invest that way any longer because markets don't operate that way any longer. This isn't the market like in the 60s and the 70s where it took 4 days for you to get some news about a company. It just, things move dramatically faster today. So being an investor and managing your own money is important. I'm gonna have to resurface an article I wrote about this a while back talking about time frames and duration risk. And duration risk in markets is very important because, again, as we talked about before, Warren Buffett buys, Occidental Petroleum. He's like, I'm going to own this stock for 100 years. Well, he's not going to be around for 100 years, but his company will be, right? But you have to invest for your time horizon. And so if you assume that high valuations mean that markets are going to crash and that eventually someday things are going to be uber cheap, that's great, but that may not exist in your lifetime. That may not happen in your lifetime. So you spend years, out of the market, not making money, making poor decisions that impact your ability to retire financially. And that's ultimately our goal. Our goal is just to navigate the markets for what we have versus not. And this is kind of, this is kind of the same idea as anything else that happens, kind of in the world is, think about taking a trip somewhere. And somebody says, hey, well, you're going to drive from Houston, Texas to San Diego, California. And some guy says, well, you don't want to do that trip because, in Nevada right now, there's just all kinds of problems. I'm just making stuff up, but I'm not saying there's something actually going on in Nevada. But in Nevada, you should not go to California because of what's happening in Nevada right now. Okay, well, I can drive around Nevada, right? I can go through New Mexico and Arizona and then go up into San Diego. It's just take I-10 and it takes me right into San Diego. There's other ways to navigate markets. But what some people choose to do is because there's an event that's occurring or one isolated piece of data, they go, well, I'm not going to take the trip at all, right? I'm going to get out of it. I'm just going to sit in cash, whatever it is. And that impairs their ability to retire at some point down the road because they didn't build that financial structure that they needed and then navigate markets. And again, it doesn't mean that there's not risk in markets. So when we invest, we take risk. I mean, that is, at the end of the day, that is all we do as investors is we take risk. And as an investor, we have to navigate that risk the best we can. And it doesn't mean, as we talked about before, it doesn't mean you just have to let everything just roll over you. Or just, stand in front of it and just let the market steamroll you. It's like, well, I knew that was coming, but I just didn't do anything. It's just, you don't have to do that. We can manage risk. We can take money off the table. We can take profits. We can hedge. We can raise some additional cash. We can buy alternative assets. We can do a whole lot of things to still participate and grow our money while navigating uncertainties in markets. And we certainly have had a lot of uncertainties this year, but that's not really surprising. We've had two, and again, it's so fascinating to me that people forget so quickly. We had a 19.2% correction, peak to trough. That's big, right? That's a decent sized correction in the markets. 20% plus corrections only happen 13% of the time historically, going back to 1900. So a 19.2% correction is a big correction. But people forget that we had two 20% return years over the last 2 years. So all we did was give up a little bit of the gain that we had over the last couple of years, and that gave you an opportunity to put some capital to work at a cheaper price. It pulled some of the froth out of the markets. But immediately, what do we do as investors? That we start saying, "Oh, well, this. It's like Sanford's son. There's a big one, Elizabeth. I'm coming home." Not every correction is the beginning of the big one. And, but that's our human nature, right? We've talked about emotions, talked about biases, we've talked about all these things in the past. But it's just interesting because, again, there's so many things that we can latch onto. Ray Dalio has been running around lately talking about the debt cycle is going to blow up. No, it's not. He's been saying this for the last 15 years. And smart guy, right? Built Bridgewater Capital, has managed billions of dollars. But he comes out and he says some crazy stuff, right? I don't know if it's just because what happens when you're a billionaire. I don't know, but just saying some crazy stuff. And I'm not saying that he won't eventually someday be wrong, but it's not going to happen tomorrow. It hasn't happened in 15 years, and it's not going to happen tomorrow. Now, could it happen someday? Sure. Right? There's been lots of concerns about, de-dollarization, loss of reserve currency. That can certainly happen. The average currency survives about 200 years. But there's reasons for that. And we don't have the environment today that would remove the reserve currency status from the U.S. today because there's no alternative. You have to have reserve currencies change ownership. You have to have a viable alternative. It just can't go into a vacuum, right? These are great narratives. They're great narratives for selling gold and stoking fear and those type of things. And again, we've talked about before is whenever you hear these narratives from somebody, what are they selling you? So, all right. I'm going to go back on the break here and check what my bid structure should look like for this 1971 International Scout. Be right back after the break. We'll get into bear market or correction. We'll kind of go through that here real quick with you. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm a little disappointed. I was expecting Crocodile Dundee to come back from this trip and have alligator tooth necklaces or some tribal tattoo, where he was adopted by some tribe.
The Real Investment Show podcast.
You don't know what I'm wearing underneath the suit.
Same show, your schedule.
You didn't come back married to some tribal princess or something?
No, I did not. Yeah, I can barely keep up with one, much less multiple.
At realinvestmentadvice.com.
They must have some really good time management.
Exactly.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Kevin, thank you for the happy birthday wish. I appreciate it very much in chat this morning. So, appreciate the help chat. So you're kind of in the ballpark in terms of ranges for kind of some recent auctions for 1971 Scouts. However, I will say that there have been 3 Scouts that have recently sold for over $100,000. So this Scout would require just a little bit of work to enhance the value of the truck. Up to those levels to go like to a Barrett auction as an example. But yeah, this is not only just an investment or a kind of a passion, which I just love old trucks and I haven't had one in decades. But it's also an investment. And if Bitcoin will just go a little bit higher, I can sell my Bitcoin and pay for it in cash. So just need a little bit more. Anyway, so we're talking a little bit about the markets. And again, this is one of the big challenges for investors. So this was kind of the point of the article today is that, there's been a lot of talk here recently. It's like, oh, it's just a bear market rally. It's going to fail. And, and we're going to go down and we're going to set new lows. Maybe. Right, that's certainly a possibility, and bear market rallies are something that certainly happens during corrective phases of the markets. And, excuse me. And can you bring up this chart for me? I can't expand it though. Oh, okay. But again, and a good example of this was 2022. If you look at 2022, there were 4 bear market rallies before the market actually bottomed, and right now, by the way, we're tracing out 2022 very closely. And I kind of laid this out last week, is that if you take a look at where the 13-week moving average crossed below the 34-week moving average, which we just did recently, back on April the 6th, the market rallied, got back above those moving averages before it failed. We had a very, very strong rally, took out those moving averages, and everything was looked just like it does now, right? It's just like, oh my gosh, the correction's over and we're back off to the races. And then the rug pull came. So I think we have to be a little bit cognizant that could certainly still be the case. And again, I'm not arguing for one way or the other, so don't think I am. There's a lot of things going on in this market. Again, this deal with China is great. It's only 90 days. What happens after 90 days? And the one thing that markets don't like ultimately is they may get short-term relief from, a news headline or something. They don't like uncertainty because they have to be able to plan. Again, everything's based on forward earnings. But again, when we take a look at, the 23-24 bear market, bull market in 23 and 24, we had multiple corrections along the way that were fairly short-lived, and we had a decent one. When there was the death of the AI trade a couple of summers ago, markets were down like 10% peak to trough, and that whole summer was just that steady grind. Everybody was super bearish, and we finally got down in October of 2023, and that was following the Silicon Valley blow up in March. But we had that fairly big 10% correction, and then markets took off running again. And, before you know it, back all the time. So again, not every correction, again, that was just 10%, wasn't 19%, so big difference. But not every correction has to, and then subsequent rally has to be a bear market rally. And there were a lot of calls following that summer of 23 correction that the rally was just a bear market rally, and then it just kept going, and it wasn't. And so my point is we have to try to, figure this out. But unfortunately, there are no indicators that say that that's a bear market rally or that's correction. We only know in hindsight, unfortunately, and that's what makes it really, really hard to navigate markets, because it's always, we're just guessing. And and so like I said, I get a lot of emails. I was like, yeah, you can say the market's going to go up or down. That's not really helping anything. It's like, that's all I can do. I can tell you that the probabilities are this. I can tell you the possibilities are this. But nobody knows for certain. And that's why I always love these analysts come on television. Like, the market's going to all new highs. That's a safe call, because more often than not, markets are going to go to new highs. So they're always optimistic. Yeah, markets are always going up, right? No, and so if they're on television, like you're in the midst of a correction, just say the market's going to go up, because odds are, more often than not, you're going to be right. About 70% of the time, the markets are going to go up. The 30% of the time the market corrects more, nobody remembers, because as soon as the next bull market happens, they all forget about the correction, and then we're back off to the races. So so whenever you listen to somebody on television and they're talking with absolute certainty, oh, this is going to happen, you never hear somebody with absolute certainty come out and go, yeah, this market's going to crash 120% over the next week, right? They never say that. It's always to the upside, because that's the safe bet. The guys that are coming out talking about, it's the end of the world as we know it, and the dollar's going to crash. We're going to have a debt default. Everything's going to happen. These very, very kind of outsized tail events in markets. They'll say that stuff for years and years and years and years and years, and eventually, maybe they'll be right. Peter Schiff's a great example of this. For years, he was talking about the coming financial crisis of the markets, and we finally had one in 2008. And for a moment, he was right. And he's been on that same stick for the last 15 years again. And eventually, someday, he'll be right again. You can lose, and my point about that is there's nothing wrong. There's nothing wrong with that, right? Your view on the markets, your opinions. I'm a huge admirer of John Hussman, super smart guy, PhD, very does fantastic, in-depth research. His fund performance has been terrible. Doesn't mean he's not a smart guy, but his fund is betting on an outsized event. He did fantastic during 2008. Since then, it's been terrible performance. And so this is why we're so very cautious about navigating markets and focusing on risk management, because we don't know. We have no idea what's going to happen, much less tomorrow, not 6 months from now, or a year from now, or 10 years from now. It's too hard to navigate that far out. But there's some reasons, again, to expect that the recent correction could be over. One that I didn't include today, of course, was the ending of this whole China debate. That's a huge relief to the markets. But earnings are good. First quarter earnings, the large majority of companies held guidance for the rest of this year. Despite tariffs, despite everything else that's going on, despite slowing economics, they did not change their guidance. That's bullish. Earnings came in about 75% of companies beat estimates. Of course, they lowered estimates a lot to be there, but that's bullish support for the markets. We're not seeing earnings kind of fall off the cliff. Financial conditions have been easing, right? And sentiment, again, this is kind of the Z-score of our consumer composite investor confidence index of both professional and retail investors. It's still very, very low. There's still a lot of negative sentiment in the markets right now. And if this market continues to rally, you're going to drag all those people that are super bearish. They're going to give up, and they're going to come back into the market. And that's going to provide that buying fuel for the markets to push or propel this market higher near term. Again, I'm not saying that markets can't have another correction, because they will. But again, the expectation that we're about to roll over and go down, set new lows, and go into a deeper bear market, that narrative is fading away pretty quickly. And so we need to be a little bit cautious about how much risk we're hedging, how much we're lacking in exposure, where we're gaining exposure. Again, there was lots of talk just recently like, oh, the AI trade's dead, the Mag 7. Take a look at it here. Let me show you a heat map for this morning. This is the heat map for this morning of the S&P. And, again, like I said earlier, if you can bring that up for me, the only red spot really is consumer staples and healthcare. Healthcare is under pressure because Trump's looking to cut drug prices from 30 to 80%. So that's weighing on companies like Eli Lilly, AbbVie, Merck, Amgen, Gilead, Pfizer, all kind of your drug makers. Staples under pressure, Coke, Pepsi, et cetera. They're under pressure. Obviously, that's just a risk-off rotation. That's where money was hiding. And so as we talked about before, money's moving out of where in kind of the safety trades, gold, staples, those type of things, moving back into the markets. But where's your hot spots? In the areas that everybody's been hating lately. It's AI, it's energy. Right? We bought energy stocks a few weeks ago because everybody hated them. And this is one of the great things about investing is, honestly, the hardest things about investing is to buy the stuff that everybody's selling. I'm really starting to like healthcare here. It's really getting oversold on a lot of different fronts, and these are companies that are printing money in a lot of cases. You may slash drug prices, but you're not getting rid of things like GLP-1 and Botox. Just ask my wife. Try to take away her Botox. That's going to be a fight. So it helps her manage her migraines. All right, quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. We have 1,000 people watching our channel this morning. Thank you so much. That is a very nice birthday present. You know what I would enjoy a lot more for my birthday is if you'd smash that like button for me. I mean, we have 183 likes and 1,000 people watching. Come on, give me exactly 1.8% right now. We have a 1.8%. No, that's not. It's 18. That's 10.8%. Okay. Yeah. So, but still. Give me smash that like button for me for my birthday. I'd appreciate it very much. So just, we were kind of going through the bullish case, kind of for just a correction, but again, we can't ignore the bear case for this market. So, earnings growth is key. That is really all this comes down to at the end of the day, because if you take a look at markets, there is a very, very high correlation between earnings growth and markets. And that happens over time. And GDP growth is where earnings come from. Now, let me be clear. I'm not talking about a massive recession's coming, but we are having a slowdown. Could we have a recession? Yes. Certainly, that's part of the normal business cycle to have a recession. It doesn't mean a recession is the same thing as a financial crisis event, right? The one thing that's happened over the years is that we now equate recessions to economic calamities, because we had the dot-com crash, which was a recession. We had the financial crisis, which was a recession. And this is since the turn of the century. And we had the pandemic, where we shut down the entire economy. That's pretty much a calamity, right? So those are the only recessions that we remember, for the most part. We had a recession in 1991. It was just a mild. Nothing in the world blew up to any great imagination. We just had a recession. It was just an economic downturn. We had recessions in the 60s and the 70s. We had recessions in the 50s. We had recessions in the 40s. Yes, we had the Depression. That was a big, big recession called the Depression. Some recessions are linked to bigger macro events. And unfortunately, in our lifetimes, most of our lifetimes, The ones that we remember, especially for you younger folk out there, you whippersnappers that aren't as old as me today, we only remember dot-com crash, financial crisis, pandemic. Those are the only recessions that have occurred in recent history that we remember or have traded through. Now, again, I remember the 91 recession. I remember recessions in the 70s. I remember those. I wasn't trading in the recessions in the 70s, but, I remember them, right? Because I lived through them. But this is why we tend to equate, a recession to this big macroeconomic downturn, and that doesn't necessarily have to be the case. We can have a economic slowdown that leads to a negative GDP growth rate without having a major financial crisis event attached to it. But the important thing to watch is personal consumption expenditures. 70% of the economy spends money. We talked about consumerism here on the show. I had a conversation with Adam on Friday about this a bit. But America is based upon consumption. Everything that we do is driven towards getting you to buy something, right? I need you to, watch my YouTube channel so that you'll buy a product or service or whatever it is, right? That's, you turn on television, even Amazon now, right, is you've got to watch ads if you don't want to pay up for ad-free viewing, because I'm too cheap for that. I'll just watch the ads. Besides, I need the bathroom break anyway. But those are, that's our world we live in. It's all about consumption. And so when we sent out these checks to households, we skewed consumption at a time when we shut down the economy and had no supply, so we got subsequent inflation. Here's a chart showing employment growth, personal consumption expenditures, private non-residential fixed investment, and fixed private investment. What you'll notice is there's a very high correlation between all of them, and primarily those are all spun off of personal consumption expenditures. Why? Because when you go out and spend money, that generates demand on the business. The business says, I have so much demand right now, I need to go hire some employees. So they hire employees. I have so much business right now, I need to do more private investment. I need to build a plant. I need to expand my production capabilities. I need more trucks for delivery, whatever it is. And so when there's more demand, those things all go up. When that demand is falling because consumers are contracting their spending, guess what happens with all those other things? I don't expand my business. I don't hire employees. Maybe I lay off employees. But that's why there's a very, very high correlation between personal consumption expenditures and everything else. And that winds up in earnings, because earnings come from what you spend. So it's important to keep this perspective in mind. And when you have an environment like now, where this chart is our Consumer Confidence Composite Index. So this is University of Michigan, Conference Board's measure of consumer confidence, a couple others. But consumer confidence is falling pretty sharply here. Personal savings rates, personal savings are running out. The economy's slowing down. People are, worried about their jobs, or their outlook for, getting a job or higher incomes is falling. So their confidence in the economy is contracting, which ultimately is going to turn into less consumption, which is eventually going to turn into what? Less earnings. That potentially weighs on consumption, and consumption weighs on earnings, and earnings weigh on markets, right? So this is earnings estimates for the S&P. You'll notice that just in the last month, there's been a very, very sharp contraction in earnings. So if you were buying earnings on April the 15th, those estimates for 2026 were $292 a share. On May the 1st, all of a sudden, the valuation you paid on April the 15th shot higher because earnings went to $274 for 2026. So everything you thought was cheap a month ago is no longer cheap. And if earnings, and this is because that consumption, that demand in the economy is slowing, and that's weighing on earnings growth. And if we continue to have slower economic growth, these earnings estimates are going to have to come down, which is going to weigh on market returns, because when you look at the annual rate of change of the market versus earnings, the annual rate of change in earnings, there's a very high correlation between those. So that's the real risk, at least for now. Again, it doesn't mean that the markets are going to crash, doesn't mean that, we're going to wind up, in, just a massive economic depression. But it does mean that there is as consumers slow down, there is both a risk of a recession within the next 12 to 18 months. There is also the risk of another corrective event in the markets in that time frame. Could be 5%, could be 10%, whatever it is. So there's certainly, and again, this is, the bearish case for the markets right now is that there is a bearish tint to the economy because of what's happening, or to the market, because of what's happening in the economy. The economy is slowing down. Interest rates are still elevated. That's weighing on consumers. Savings are running out. That's weighing on consumers. Debt structures are going up. That weighs on consumers. Credit cards, auto loan payments. Student loan debts are now getting collected on. That's weighing on consumption. And even if it's not weighing on you personally, it's weighing on you psychologically, because you're hearing all these stories. So maybe as you hear these stories, you contract your spending. But that's why recessions are psychologically induced. See, and this is one thing we've always talked about before, is that, if the Fed came out tomorrow, as an example, and said, you know what, we're going to have to cut rates by 75 basis points at the next meeting because we're about to be in a recession. There's no way around it. The recession is coming. You would literally be in a recession tomorrow, because the markets would probably crash by, 1,500, 2,000 points immediately on that news. That would ripple through the headlines that the Fed said a recession's coming. So immediately everybody stops buying stuff. They just immediately contract. And employers say, recession's coming, we better lay off people today. So you have mass layoffs all at once. So just a psychological change can lead to a recession through the actions it instigates. And this is why the Fed can never come out. This is why the Fed gives you a standard, set of language at every meeting. We're watching employment, we're watching inflation, blah, blah, blah. We're paying attention. Because they can't come out. They can't say a recession's here, or a recession's coming, or we're expecting a recession, so we're going to cut rates. Because if they said that, it would happen. It would be psychologically induced through our behaviors. So this is why Wall Street spends so much time parsing data and all this stuff, this type of stuff. And this is why, political figures, are very cautious in general about what they say about the economy, those type of things, because it can create the very thing you're trying to avoid. Anyway, that article's on the website. It's the bull case, bear case, correction or not. It's on the website right now. If you have any questions, feel free to email me. And get lots of questions over the weekend, obviously, with stuff that's going on. So feel free, send an email. Get by the website. Our latest newsletter is out as well. We went to a lot more depth about earnings in this past weekend's newsletter. That's on the website as well, the Bull Bear Report. Other than that, have a great day. Thank you so much for the birthday wishes today. I really appreciate it. We'll be back tomorrow with John Penn right here on the next edition of the Real Investment Show. Hit that like button.